Payment protection based on 2019 gross pay per the AICPA. So there's two issues here that they're addressing the AICPA, that being the calculation period, that being 2019, and the gross pay versus, say, the net pay. Now, note that the AICPA is going to be an influential body. They're not actually the law, so you got to think the law and how does the AICPA recommendations fit within it. I'll talk a little bit about that later, but they are a good source, good influential body to take recommendations from. Now, the main guidance as I read this is they're giving information with regards to, this is the actual application form, and this is a mock application form. You can find it. They issued this a while back, so you can kind of get your numbers ready. And they're really looking at the confusing component here is obviously the calculation of the loan amount. So everything comes down to that calculation. They give some guidance down here in the instructions of the form. So if you roll down to the instructions on this form, it says that to calculate this, for purposes of calculating the average monthly payroll, that's going to be the key item they're looking into. Most applicants will use the average monthly payroll for 2019, excluding costs over $100,000 on an annualized basis. So they are referencing 2019 within this application form that was issued some time back, and then you got this term average monthly payroll. Well, so what does that mean? So if you were to see this on itself, you might say, well, you might ask yourself, well, does that mean the net paycheck? Like if you get a paycheck, does that mean that you're supposed to take the gross pay before they take out the taxes, which is Social Security, Medicare, federal income tax, for example? Or do you take the net check, the money that's actually been received? Now, it's not too clear on the instructions here, but if you look at the actual bill, and this is the actual bill that talks about the payroll costs, and it describes what's included in payroll costs, and you've got salary, and you've got items down here, including payment on retirement benefits, and so on and so forth. It doesn't say anything about reducing it by the taxes, by Social Security, Medicare, payroll taxes, for example. So I think, I kind of assumed when looking at this that it would be the gross pay that you'd be using, not the net pay, and so that's one of the issues. Are you talking gross or net? It looks like they're giving guidance, and it seems appropriate that they're talking about the gross pay, not net pay. In other words, not net, not taking away the Social Security and the Medicare. It's still a little bit confusing on how to actually calculate that gross pay, because when you look at the payroll forms and think about, all right, well, what number am I going to be pulling from the payroll documents? If I look at like a W-3, the gross pay includes line 1, 3, and 5 are all kind of variants on calculations of the gross pay. This is gross pay for federal income tax, gross for Social Security and Medicare. And then you got to factor in the fact that if you have people that made over 100,000, you've got to compensate for that amount that was over the 100,000. So I'll get back to that. That's still a little bit confusing, but it's still it's the gross pay and not the net pay is one of the issues. Now the other issue is saying, well, should you calculate based on 2019 numbers? Or there was some indication that you could have read the new law that they put out there, the adjustment, that it might have been part of 2020 and 2019. And so the AICPA is saying, look, it's 2019 they're looking toward. And I think this came from the interim final rule that was issued. So you had the initial bill, and then you had the application, which were clearly the application indicating 2019, and then you had this interim final rule. I think this led to a little bit of confusion on the time period that's covered. Down here in 2E, it says, how do I calculate the maximum amount I can borrow? The following methodology, which is one of the methodologies contained in the Act, will be most useful for many applicants. Step 1, aggregate payroll costs defined in detail below in F from the last 12 months for employees whose principal place and so on. So this says the last 12 months right there. And so if you're talking about this period or the date that you're getting the loan, you might say, well, maybe that means the date I filled out the application, the last 12 months prior to that. And if you interpret just that, you might say, well, that would mean, the first quarter of 2020 and possibly the 3 quarters of 2019. So it looks to me like everything up until like this point was pretty consistent 2019. So you would think that maybe this was just something that could have been a little bit more clear. And I'm not trying to criticize anything because obviously they're cranking this out really fast and they're trying to make adjustments as they go. But you could think that maybe they could have put, 2019 here, and that might have caused some confusion. Now, there's two types of things that could happen when that happens. It could cause confusion and someone picks up the wrong date, so they do their calculation based on the last 3 months and then the first month of 2020. Or they could say, hey, look, I'm going to interpret this as the law, basically, and this supersedes anything that happened prior to it. And if it comes out to the fact that the calculation is higher based on this, could you argue that this is precedent over the prior calculation and use the one that's most beneficial to you? Now, I'm going to argue. Now, obviously, from my perspective, I would argue if you haven't filled out, I would argue to be in agreement with the AICPA and say, it looks like they mentioned that the spirit of the law up to this point was obviously 2019. I would go with that recommendation, but you can see this here. I'll go into a little bit more detail on that later, on that kind of argument later. But just in general, what does that mean? Those two things mean at this point in time? Well, what if you either at this point in time have already filed an application because this thing started on Friday, but a lot of banks didn't have it out yet. So you could have filed an application. If you filed it and used 2019 numbers, then you're good at that point in time. If you filed it and you used the net pay instead of the gross pay, it could result in less money at that time. And then you have a question, or what am I going to do at that point? It's hard to contact the bank because, you can't really call them or get through as easily because they're going to be overwhelmed with this stuff. I think you might have to wait till they actually get back to you and ask for documentation or something like that at that point in time. And then what if you did the calculation based on the wrong recommended period? If you did that unintentionally and you thought, well, I thought based on this that I should have done the last 3 months and then the first month, but I'm happy to take the recommendation of the AICPA if that was indeed the intention. I'll do whatever you want for the bank to be in compliance with whatever the intention of the law is. Again, you can't really, if you send in another application, you would think that would confuse the process, right? So at this point in time, you send in the application and one or two things happen, you would think at this point in time. Either they just send you a check. They're like, all right, we accepted it. Here's the money. And at which point you can address it later. You've got the money and then you can address it maybe at a later time when things are, slow down and you could talk about the bill with the banker at that time. Or they're going to come back and say, hey, give us the documentation, the payroll documentation and you could say, okay, at that point, well, here's how I calculated it. Here's the last 3 months and the first months of the current time period. And here is the calculation based on 2019. Here's all the documentation. And if they want to make that adjustment, it should be pretty easy. You just adjust that one number at that point of time when they look to verify the calculations, if they choose, to verify at that point. So those are the major kind of issues. Let's actually look at the AIC and what CPA and what they say here. So again, the AICPA, not the actual law here, but a respected body that's giving guidance on the law of it. So let's take a look at it. The AICPA Coalition recommends PPP applicants use gross payroll approach in calculation. So Washington, D.C., this is April 4th. For the calculation of the average monthly payroll cost under the Paycheck Protection Program, the PPP, the gross payroll approach should be used for the application according to the recommendation from the AICPA-led Small Business Funding Coalition. This recommendation was developed in conjunction with the National Payroll Reporting Consortium, the NPRC. It comes after additional guidance guidelines Treasury and Small Business Administration, the SBA, issued on Tuesday. So notice they're given kind of their credentials here to give recommendations on the law. For the calculation of the average monthly payroll cost, we recommend that payroll providers and CPAs use gross payroll based on 2019 data versus net payroll, defined as gross payroll less federal withholdings, employee and employer FICA. So the gross pay, the top line, not the bottom line, not taking out the payroll taxes. Neither CARES Act nor the recent guidelines instructs the PPP applicant to exclude the federal withholding, employee and employer FICA for the 2019 period. So note, when we looked at the law, it just basically says, here's what's included in wages. And none of it said, there's nothing there that said you need to exclude or take away. It seems to me, that's what they're saying here. It seems right to me that you need to take away the taxes based on it and get to the net pay. So the average monthly payroll cost includes gross payroll and the other defined PPP payroll cost elements such as healthcare, etc. So notice those payroll costs that are included that aren't actually like wages, benefits, some of the benefits, including healthcare, etc., are also things to be in consideration. Treasury and the SBA have acted quickly to generate this small business stimulus. As key stakeholders in the implementation of the PPP relief, we are collectively working to drive consistency in the interpretation of the administration's guidance. Our goal is to help produce an efficient application process to quickly get the funds in the hands of small businesses and their employees. Okay, Executive Vice President of the firm. Based upon statements from the members of Congress, it appears that the intent of the PPP was to base the salary calculation on gross wages with no adjustment for federal taxes. This ensures that payroll tax expenses are not passed to the small businesses in need. In a program of this magnitude, it's expected that guidance will evolve and the terms will be clarified. And I think that's true. Obviously, again, they're pushing this out really quickly, so it will need guidance quickly to answer questions and make this work. The AICPA also said that its discussions with the Treasury, SBA banks, and payroll processors to address these and other issues are ongoing, and that it will keep its members, coalitions, partners, and other businesses updated on the efforts to protect Main Street Americans. Okay, so that you got the gross pay versus the net pay, and now we're thinking 2019. That makes it easier because if you think about just 2019, then you got a whole year grouped together. You don't have to be pulling apart quarters or months or something within the payroll. So that's nice. And then if you go through the actual forms, it's still not that straightforward. It's still a little confusing here because then you might think, well, what if I took a look at the W-3, which is kind of like all the W-2s put together, and think about, well, what line should we take? This would be like if all the employees were scrunched together into one employee and they got one W-2 for all of them. You still have like box 1, 3, and 5 if you were to consider this. And box 1, it doesn't include. If you take box 1, it's usually reduced by things like a 401k plan and possibly other things like health insurance, possibly, right? Because this is the wages for federal income tax purposes calculation. And you have to account for the fact that it could include employees that made over the 100,000, in which case you have to take out the amount that was over the 100,000. And then box 3 is usually one that you're not going to, it's a calculation for the wages based on Social Security. And it's not usually good if you have high earners, because the high earners are going to be making something over, it's going to distort the number for the Social Security number. Now, again, you're going to have to pull out the high earners anyways, because anything over the 100,000 you're going to have to account for anyways. But normally you don't take the Social Security because oftentimes the wages here could be lower than the Social Security if you have people that make high earners, because they had this top number usually decreases the wages by things that aren't taxable for federal income tax purposes, such as a retirement plan. And so oftentimes the Medicare wages down here is oftentimes like a closer reflection of the actual payroll number, because it's not going to be reduced typically by the 401k plan. Now, it could still be reduced by like certain types of things, like possibly a cafeteria plan or something like that you'd have to take into consideration. But of these three numbers that are just on the W-3, you'd think maybe the Medicare's the gross wages is the one you'd want to consider. You'd want to consider the wages that aren't being reduced by, you would think, the 401k, because I believe the law says that the 401k is included. And then you'd have to adjust that if you had anybody that made over the 100,000. You'd have to account for all those that are over 100,000 and cap them at the 100,000. And you can also think of that number in terms of, the 941s would be this line 2. This is the 941s. You could try to add them up, right? The 4 quarters on the 941, add up the 4 quarters for 2019. But you would think line 2, but again, line 2, I believe, is generally going to be related to the federal wages, which may exclude some, and then you'd have to exclude the some items, including possibly the 401k or something like that. So, and then if you take, and then of course you've got the 940 as well. So if you jump back over to the bill here, it says the term payroll costs, and I'm assuming this would be included, would be these items: the salary, the wages, the commissions. That makes sense. Payment of cash tips and equipment, payment for vacation, okay, allowance for dismissal or separation, payment required for the provisions of healthcare benefits. So those that's kind of like the issue, one of the issues, right? I mean, which line you want to make sure that you're picking up the healthcare benefits when you're picking this information up from your your payroll information, and if you can, right? And it seems like that would be, and then if it's allowed, and it seems like it would be, so payment of any retirement benefits. So again, the retirement benefits, are you picking up the retirement? Because it seems like that would be included in the wages, and if you pick up line 1 of just like the W-3, then you may not have the retirement benefit, so you want to just, be careful on the benefits, make sure you're picking up the benefits that you can, Payment of state and local tax assessed on the compensation of employees. And then we have this item: the sum of payments of any compensation or income of sole proprietor or independent contractor is a wage. So then you have, well, what about the situation with the sole proprietors? And this gross and net thing can be kind of confusing. So that's my kind of interpretation, just for what it's worth, of of how you're going to calculate this if you're like, a business and you're trying to calculate the what number to take in. So those are just my thoughts on it. But what if you're self-employed and you don't even have any employees, or what if you do have employees, or you're self-employed, you have a Schedule C? Then that's a bit confusing of a situation too, because you would think I'm interpreting that to mean that you would get the Schedule C. Generally, it would make sense to me that you would get the Schedule C. If you have a Schedule C, you're still paying self-employment tax, and so I would think that would be the net, the net income here that you have to pay self-employment tax on, would be the item that might be subject, that you might be able to use as part of your pay, because you're paying self-employment tax on it. And that's what this last part of the bill, what I'm getting from this last part of the bill here, is saying, so the sum of the payments of any compensation to or income of a sole proprietor or independent contractor that is a wage, commission, income, net earnings from self-employment, or similar compensation. So when you're talking about gross or net pay, I don't think, if you're a sole proprietor, I don't think that means that you take the top line of the Schedule C, as your gross pay. I would still think that you would take the net of the Schedule C, if that happens to be your situation, and because that's what you pay the self-employment tax on. But again, that's that's just my interpretation there, that this, if the Schedule C is something that qualifies for this calculation, that could be a little bit of a confusing component of it as well. And I think, again, when they talk about the gross and net pay, I don't think they're talking about, gross pay on the Schedule C. They're talking about gross pay for wages purposes, not including, obviously, the payroll taxes. For the Schedule C, you pay kind of like payroll taxes, but you pay payroll taxes on the net wages of the Schedule C, which are going to pull over to the Form SE, which is the self-employment tax calculation. So I would think that the wages that you pay self-employment tax on would be the ones you're using here. Assuming the net income is something that would be allowed, given the fact that you're paying, you're treating yourself as basically an employee, as would seem reasonable given this information and given the fact that you're paying, payroll taxes on it. The other confusing factor are like the benefits too, with a Schedule C type of business. Do you include, because if you talk about like health insurance for a Schedule C, it's not going to be on the Schedule C, that's going to be somewhere else. So then there's, could you include the health insurance for someone who's got a Schedule C type of business? So anyways, those are just a few of the items there. That's the AICPA's recommendation. it's also just kind of interesting to note here that, if you take a look at the actual law here, that you could, this was the adjusted law, you could still go to this law and say, well, this thing says the last 12 months. And let's just imagine, just for a hypothetical, and again, I wouldn't recommend doing this. I would take the recommendation. It looks to me like obviously that was the intent, and whatever the intention was, then it's probably best just to go forward with that. But just to take the argument here, notice that you could say, well, this is the law and it says the last 12 months, and let's say that came out to be beneficial for the calculation, that you'd get a much bigger number if you were to use that. You could make the argument that you send that in and you try to argue to make that number, but I'm not sure that would be a good idea in this particular circumstance. And this is just my opinion on it. Because note, if things were a little bit different, oftentimes it's useful to have like kind of an aggressive lawyer or CPA that's going to be arguing topics like these. If the law comes out and you interpret it this way and someone else interprets it the other way, the AICPA might interpret it this way, but I'm going to say this is the authority at this point in time, and therefore I'm justified to take action based on this point in time. Now, that might be useful sometimes in normal circumstances, because what you're really doing is usually you're telling the IRS, trying to stop the IRS from taking your money, right? So usually you have the money and you're trying to stop the IRS from taking it. And then if your lawyer or CPA argues every point about the law and tries to justify their opinion of it, then if that takes a whole year for that process to work out, well, fine, because you already have the money and you're waiting for like a year for this thing to work out. So that might be a good thing in that case. Some people, it could be beneficial in that case. But in this case, it's a little bit different, because in this case, you're looking for a loan. You don't have the money at this point in time. So I'm not sure it would be beneficial to have like an aggressive, lawyer or CPA that's going to argue every line item to get every dollar of the loan money at this point in time. Because the last thing you want to have happen, it would seem to me, is for your application to be at the bottom of the application process and then never get processed, right? So I would think, at this, and plus it's just this, does make sense that they're, it looks like they were going for 2019 in any case. But from just a strategic standpoint, it's just funny that it's a little bit different the way it would normally be, right? It would normally be you're trying to stop the IRS from getting your money, and you argue every kind of line item that you can within the rules of the law. In this case, it might be beneficial just from a practical standpoint to not do that, because what you're trying to do is process the loan as soon as possible, and then you could go and possibly argue at a later point in time once things kind of settle out. But that's just my perspective on it. I would think most people would be beneficial at this point to say, I'm going to comply with whatever I got to do to get the loan processed, so you get the money as soon as possible, considering there's a time restraint. You don't want the application to go to the bottom of the pile and not be, gotten to, as opposed to having the money and trying to stop the IRS from getting it. So it's just kind of interesting dynamic that it's a little bit different dynamic on how you would interpret this, but that's just my opinion on it.